So QE by itself is not a very inflationary thing for consumer prices, meaning the price of commodities, the price of everyday goods, because there's not more money chasing more goods. What's inflationary is when there's large fiscal stimulus that is generally monetized by QE, and then that fiscal stimulus gets out to the public. And when I talk about the last battle, so a lot of people are saying, oh, that whole period from 2008 to 2014, all that QE, it wasn't inflationary. I'm like, well, yes, but also there was not a lot of fiscal stimulus back then. You had around the margins, you had fiscal stimulus. But if you looked at broad money supply, there was no big spike in that whole period. You had a big spike in base money. You recapitalized the banking system, but you did not have a spike in broad money, meaning that the accounts that people like me and you have at our banks. So the actual money in circulation among market participants, that did not really increase at any sort of notable rate.
Over the past few months, there have been a lot of uncertainties about the economy of the United States and the rest of the world. It's been a few months since the U.S. Consumer Price Index hit a 40-year high, and experts are still divided over what the rest of the year is going to look like for the world's leading economy. While some predict a nasty recession which would last through the year and spill into 2023, others believe we could be looking at an extended period of stagflation instead. Regardless of the divided opinions and economic uncertainties, most experts agree on one crucial issue, which is the fact that the U.S. economy has seen better days. We've had a contraction in the GDP for the first 2 quarters of 2022, the standard metric for defining and identifying a recession. The last time the U.S. recorded 2 consecutive quarters of negative GDP growth was in 2020 when the world was battling a pandemic. So, what happened? How did the U.S. economy get to this stage, and what will be the consequences for everyday consumers and investors? In a recent interview, Lyn Alden, renowned macroeconomist and the founder of Lyn Alden Investment Strategy, attempts to shed some light on the correlation between quantitative easing, debt, and inflation. Please watch, share, and like this video as we bring you this important update from Lyn Alden. We also love to hear from our viewers. So ensure you drop your comments and observations in the comment section below and subscribe for more videos. Thanks, and enjoy the video.
We had a couple rounds of it. We had 1,200, I think then we had 600, then we had, 1,400. Then you had child care tax credits. Then you had PPP loans for small businesses that turn into grants. A bunch of different rounds of stimulus.
And do we know how much of that was in total? Like the total value of that?
So last I checked, something like 6 trillion.
6 trillion. So that is 6 trillion of new broad money.
Yes. And so unlike the whole 2008 period, if you look at a chart of broad money, it goes straight up.
Right.
Because that now there's actually a mechanism that's getting at the public. It's not just base money going up, it's broad money going up. People actually have more money in their accounts that they can go and spend on restaurants and things and rent and houses and whatever they want. One big variable is the money printing.
Yes.
Especially, specifically the broad money. The other variable is things like commodity capex. Have we invested enough to make commodities abundant and cheap or not? Because if we have just unlimited, if we had a world we had unlimited oil and you print a lot of dollars, you might not get a big price spike in oil because there's just endless amounts of it. Everyone has excess. And so as soon as the price goes up a little bit, they're like, sure, I'll sell the oil. But if you have a constraint in how much oil exists and there's a lot more money in circulation that wants to buy that oil, the price is going to go up quite a bit. So there are real world constraints on logistics and commodities, those things in particular, that are the other side. They're the supply variable with money printing and money supply being the demand variable. If you look at the 1940s, and this is the part where I just disagree with Jeff on. He would say that's not an example of real inflation. That's supply side problems. So I have these charts that I've used in articles. For example, if you look at the 1940s, you had these huge spikes in inflation, huge spikes, and it comes back down. Then another huge spike comes back down. When that's all said and done, though, if you just kind of zoom out at what did the CPI do in the 1940s, each one of the spikes, it went up, and then it stayed at a new higher plateau.
Yes.
And then went up, and it stayed at a new higher plateau. Then went up.
If it's not coming down, then it's not transitory. That is because of the increase.
That's because of the increase in money supply. So the speed with which it happens in a short period of time is related to, one, how much money is being created in a short period of time, and then also what are the specific bottlenecks. So there are certainly individual prices during, say, the 1940s or during now that spiked to crazy level. Let's say in April 2020, everybody wants Clorox because everyone wants to disinfect everything.
Yeah.
There's a huge Clorox shortage. People are like, oh, well, I'll give you Clorox because we triple the price. So when that period ends, Clorox is probably going to come down in price a lot.
Yeah.
That's not going to come back up to that. That's not a higher plateau. Now, I mean, some of it might be, but some of the extreme spike will come off. but it's the aggregate average price level. When that stays permanently higher plateau, that's because there was more money permanently in the system. We saw that in 1940, so we had these crazy spikes, but when it settled back down, it settles at a much higher plateau each time. We saw that in the 70s. We saw that to some extent in the 2000s, less extreme. And then we're seeing that now. So, for example, when Chipotle raises wages and raises burrito prices, that we're never seeing those. It's not like when this is all done, they're like, okay, we're going back to our prior burrito price. That those are permanently higher because there's permanently more money in the system now.
There's a complete squeezing of the middle class. Is this happening purely because of inflation? Is it inflation driving this? Is this the damage it does? It just erodes out value.
Yes, but it's correlated. I mean, basically, inflation's happening in part because that's happening.
Yeah.
And then inflation circles back and makes it worse. Inflation doesn't come out of a vacuum, right? If we didn't have super high debt already, if we didn't spend decades building a very kind of fragile but efficient global supply chain, we would be in a better place to absorb some sort of economic shock, right? So because we're already in a very disadvantaged position, and we already had issues building, and we haven't invested a lot in natural resources for the past 5 years globally. When we get an external shock, and then it's like you're facing then a deflationary crash, which deflation's good in a low debt system, but in a very high debt system, that the whole system is built on credit expansion and inflation, like mild inflation, and you get a deflationary crunch, that threatens all the debt in the system.
Because it becomes even more expensive to pay it off.
Yes. It threatens the way the whole system functions because everyone's debts harden relative to their economic output.
Alden, a big Bitcoin supporter and advocate, also speaks about the world's largest cryptocurrency and its infamous volatility. As much as Bitcoin appeals to retail investors because of its rare qualities, institutional investors haven't taken to it as fast. And it is mainly because of its volatility. Big money investors like family offices, sovereign funds, multinational investment banks, and other giant corporations are yet to flood the crypto space as much as we want because they need more stability. At the moment, Bitcoin certainly does not give such assurances.
Well, with Bitcoin's kind of curve of adoption, I would put it into two separate camps. So one is when it's this new thing and it's reaching whatever total addressable market it's going to one day reach. We don't know. That's the future is always unknowable. We don't know all the full scale risk. But let's say it's going to go up to some very large share of the market. Right now, it's nowhere near that. It's held by actually a pretty small percentage of the population. There's hidden pockets of leverage in the system, like we've seen with some of these lenders. For example, it's often used as collateral to make bets on altcoins and things like that. And so there are multiple things that can add or decrease volatility. So when it goes up in price a lot of new people discover it for the first time, or at this point they've heard of it, but they might not have really looked into it, and they start to look into it again. So there's new buyers flood in, that adds upward volatility. And then when you get that leverage and that speculation, you get sharp downward volatility. Now, if you go through, let's say 5 more of these cycles, and we're 20 years in the future, and Bitcoin is more steady state, and it's held by 30% of the world population, whatever number it is, you'd expect it to be a lot less volatile in that environment than it is now. So I generally agree that in the really early phases, unless you specifically need censorship resistance or unless you're in an unbanked environment, for a lot of people in developed countries, Bitcoin is not the ideal medium of exchange unless they're deplatformed or they just really want to use it, right? They're super into it. But it's really about what it looks like years from now. And I think part of what makes it valuable now as a medium of exchange is the fact that it gives you that optionality. It gives you that resistance to deplatforming, that portable money that you can move around the world, self-custodial. I think those are the attributes that make it super valuable now. And then as we see more maturity, more adoption, more Lightning Network, better user experience, I think that makes it better and better as a medium of exchange.
As with all of her interviews, Lyn Alden has shared some golden insights about the U.S. economy here. What's your take on some of her points, especially the effects of quantitative easing on the economy? Please share your comments and observations below, and don't forget to like this video. Thanks for watching.